In the world of real estate investing, one debate continues to grow louder every year: Airbnb versus long-term rentals. Both strategies promise income, financial freedom, and wealth building. Both also come with risks, responsibilities, and trade-offs. Some investors swear by short-term rentals, pointing to high nightly rates and flexible use of property. Others prefer the stability of long-term tenants, predictable cash flow, and fewer operational headaches. So, which strategy is better? The answer depends on your goals, risk tolerance, time availability, and market conditions. In this video, we will break down Airbnb and long-term rentals side by side, covering income potential, expenses, management effort, regulations, risk, scalability, and lifestyle impact. By the end, you will have a clear understanding of which model may be right for you. Let's begin with the basics. What is an Airbnb or short-term rental? An Airbnb, or short-term rental, is a property rented out for short stays, typically ranging from one night to a few weeks. Guests are often tourists, business travelers, digital nomads, families on vacation. Short-term rentals are usually fully furnished, professionally cleaned between guests, and marketed on platforms like Airbnb, VRBO, or Booking.com. Income is generated per night, similar to a hotel, but with the benefits of residential real estate ownership. What is a long-term rental? A long-term rental is a property leased to a tenant for an extended period, usually 6 months to 1 year or more. Tenants treat the property as their primary residence and typically pay rent monthly, cover utilities in many cases, provide security deposits, sign legally binding lease agreements. Long-term rentals are the traditional backbone of real estate investing and are widely understood by banks, governments, and investors. Income potential. Airbnb versus long-term rentals. Airbnb. Income potential. One of the biggest reasons investors choose Airbnb is higher gross income potential. A property that rents for $2,000 per month long-term might generate $150 to $300 per night as a short-term rental, $3,000 to $6,000 per month in gross revenue during strong seasons. Short-term rentals benefit from seasonal demand, event-driven pricing, dynamic nightly rates. However, this income is not guaranteed. Occupancy fluctuates, demand changes, and slow seasons can dramatically reduce earnings. Gross income may be higher, but it is also less predictable. Long-term rental income potential. Long-term rentals typically generate lower gross income, but offer consistency. Rent is fixed by a lease, which means stable monthly payments, easier budgeting, predictable cash flow. While you may not earn as much during peak tourist seasons, you are also protected from sudden drops in demand. Long-term rentals focus more on net stability than maximum revenue. Expenses. The hidden difference. Airbnb. Expenses. Airbnb properties come with significantly higher operating costs, including frequent cleaning linen and towel replacement, furnishing and decor utilities paid by the owner, internet and streaming services, platform service fees, restocking supplies, maintenance from heavy use. Short-term guests treat properties differently than long-term tenants. Wear and tear happens faster. What looks like high profit on paper can shrink quickly after expenses. Long-term rental expenses. Long-term rentals generally have lower ongoing expenses. Common costs include maintenance and repairs, property management fees, if applicable, vacancy periods between tenants. Tenants often pay utilities, internet, minor upkeep. This makes long-term rentals easier to forecast and manage financially. Management and time commitment. Managing an Airbnb. Running an Airbnb is closer to running a hospitality business than owning passive real estate. Tasks include responding to guest messages, coordinating cleanings, managing bookings and pricing, handling complaints, dealing with emergencies at all hours. Even with automation tools or property managers, short-term rentals require active oversight. For investors who enjoy hands-on involvement, this can be rewarding. For others, it can become overwhelming. Managing a long-term rental. Long-term rentals require far less daily involvement. Once a tenant is placed, rent is collected monthly, communication is minimal, maintenance is occasional. With a property manager, long-term rentals can become nearly passive. This makes them ideal for busy professionals, investors with multiple properties, those seeking stable, low-effort income. Vacancy risk. Airbnb occupancy fluctuates based on seasonality, tourism trends, local events, economic conditions. A slow month can cut income dramatically. Short-term rentals also face platform algorithm changes, increased competition, travel disruptions. Vacancy risk is higher but often offset by higher nightly rates during strong periods. Long-term rental vacancy risk. Long-term rentals experience vacancy mostly between tenants during market downturns. Once leased, vacancy risk is minimal for the duration of the contract. This stability is appealing during uncertain economic conditions. Regulations and legal risk. Short-term rentals face growing regulatory pressure worldwide. Common restrictions include permit requirements, zoning limitations, night caps per year, primary residence rules, higher taxes. In some cities, Airbnb-style rentals are heavily restricted or banned entirely. Regulatory changes can instantly impact profitability. Long-term rental regulations. Long-term rentals are generally more protected and accepted. However, risks still exist. Rent control laws, tenant protection regulations, eviction moratoriums. Despite this, long-term rentals tend to face less sudden regulatory disruption than short-term rentals. Financing and insurance. Financing an Airbnb. Lenders may view Airbnb properties as higher risk, business income rather than rental income. This can result in higher interest rates, larger down payments, and more documentation. Insurance costs are also higher due to frequent guest turnover. Financing a long-term rental. Long-term rentals are well understood by lenders, easier to finance, often eligible for better loan terms. Insurance is simpler and cheaper. This makes scaling a portfolio easier over time. Risk profile comparison. Airbnb risks, income volatility, regulatory uncertainty, guest damage, platform dependence. Long-term rental risks, non-paying tenants, difficult evictions, rent control impacts. Neither strategy is risk-free. They simply carry different types of risk. Scalability. Scaling Airbnb. Scaling short-term rentals requires systems, teams, automation, strong operations. Each additional property increases complexity. Scaling is possible, but it often becomes a business, not a side investment. Scaling long-term rentals. Long-term rentals scale more easily. With standardized leases and management, portfolios grow smoothly, cash flow remains predictable, operations remain simple. This makes long-term rentals attractive for investors seeking portfolio growth. Lifestyle considerations. Choose Airbnb if you enjoy hospitality, want flexible property use, are comfortable with variability, and can handle active management. Choose long-term rentals if you value predictability, want passive income, prefer low involvement, and plan long-term wealth building. Which strategy is better? There is no universal answer. Airbnb offers higher potential income, more control over pricing, greater flexibility. Long-term rentals offer stability, lower stress, easier financing, long-term consistency. The best strategy depends on your market, your time, your risk tolerance, your financial goals. Some investors even combine both strategies for balance. Final thoughts. Airbnb and long-term rentals are tools, not rules. Success comes from choosing the right strategy for your situation, not following trends blindly. Understand your market, run the numbers honestly, consider your lifestyle. Real estate rewards patience, planning, and adaptability. Thank you for watching.